Coming up on the Wheelhouse Retirement Show, we'll be discussing a portion of retirement known as the income valley, the stage between full retirement and when those pesky required minimum distributions begin, and how, if planned for properly by using tax-savvy withdrawals, Roth conversions, and other strategic tactics, it could save you and your family tax dollars for years to come. And later on this week's planning tip of the week, Rishi's going to discuss qualified opportunity zone investing, a tax strategy introduced by the Tax Cuts and Jobs Act of 2017 that could potentially help minimize the taxation on your retirement portfolio. The Wheelhouse Retirement Show starts right now.
Retirement is more than a destination. It's a journey that starts with a dream, a vision for the way you want to live, recharge, and give back. To get there, you need a plan to make your retirement dreams come true. Now, in its fourth season, the Wheelhouse Retirement Show gives you the strategies you need to plan your ideal retirement. From income planning and wealth management to strategies for taxes, healthcare, and leaving a legacy, Rishi Ghosh and the experienced team at Wheelhouse Advisory Group provide one-stop modern solutions for your journey to and through retirement. With 3 locations, it's your go-to solution for all things retirement. This is the Wheelhouse Retirement Show.
Welcome to the Wheelhouse Retirement Show. I'm Amy Sharp, and here with me today, Rishi Ghosh with Wheelhouse Advisory Group. And it's always good to be back with you. You know I have to ask you, it's been a year since Sweet Naya came into your life, and I know you just had a wonderful celebration with her.
Can you believe it, Amy? I still remember, it feels like yesterday when I was telling you that Rima's officially pregnant.
I know.
Here we are, how quickly a year flies, and we were able to throw a beautiful little birthday party at our own house here. As you can probably see from the picture here, little Miss Naya loved icing, got it all over her face. You and I were chatting before the show about how when I had to take away the cake, it was probably like the end of the world to her at that point. But we were able to get her playing with some balloons and got her excited about it. But it's been unbelievable how quickly time flies. My clients have told me for years, right? The older you get, the quicker time goes. And it was just an unbelievable memory. I know she won't remember it, but I know her mother and I will always remember it.
That's right. You know I have older girls, so I've already kind of been through that phase. But that is a rite of passage with that first cake and all the balloons and the fanfare. But yeah, like you said, she wanted the boxes the next day.
Didn't even care for the presents, wrapping paper and boxes.
Well, she is precious, and we could talk about her the entire show, I know. But as much as we'd like to do that, we're going to get right into a topic that's crucial to retirement planning, and that is called the income valley. I want you to kind of tell us about the basics of income valley.
So, Amy, as you know, in order to be a fiduciary financial advisor, I'm constantly reading, whether it's publications from the IRS, whether it's articles from Charles Schwab, Fidelity, Vanguard, wherever. I'm always looking for different opportunities to keep our clients and our viewers up to date on new information with retirement planning. And I came across an article from Fidelity, and I thought they described this portion of retirement that we're going to talk about today in a very unique fashion called the income valley. Now, for those who have watched our show for years or our clients that have been with us for years, right, we've always described how crucial is the time period of 5 years from pre-retirement leading up to retirement, and then the first 5 to 7 years after retirement. It's a very nerve-wracking time. You're transitioning from the growth phase of your life and the accumulation phase of your life into spending your money for the first time ever, whether you're spending it for day-to-day expenses or one-off expenses. And oftentimes I see that people don't really create a strategic plan for this portion of their retirement because they're very nervous, right? They're pulling $5,000, $10,000 a month out of these portfolios. So Fidelity described this area of retirement, these first few years after retirement, as the income valley. And it's that time period between retirement and the age where required minimum distributions begin, right? 73 for some people. If you were born after 1960, 75 for some people, right? But the idea here is to create a strategic plan for those that may not need to withdraw only from tax-deferred accounts, but create the strategic plan to draw down your income from taxable accounts or checking accounts or CDs. And we've seen situations, that doesn't work for everyone, where taxable incomes drop to almost $0 based on the standard deduction. The income valley is an amazing time to put a tax plan in place, not only to keep your tax rate low for the first few years of retirement, but also think about the longevity of your retirement as well, the 5, 10, 15, even 20-year plan before tax rates go up. So it's a very strategic time. And like I said, I had never heard it described like this, the income valley, and I think this is the basis of today's show.
Absolutely. And you've mentioned that various investment accounts have different tax treatments. Expand on that for us.
You know, we've talked about this for years, but I still see when people come to our office, they don't quite understand tax diversification in their portfolio. And there's essentially 3 different types of tax classifications when it comes to accounts. And now, as a reminder, these are not investments. These are strictly how accounts are taxed. And the first one is just taxable accounts, right? What people have been used to for years, CDs, money market accounts, maybe trust accounts that they have at their local brokerage firms. Then we've got the most popular type of accounts, which are the tax-deferred accounts, right? As we call it, the tax-later account. Those are your 401ks, 403bs, your IRAs, maybe tax-deferred annuities. These are the accounts that we were taught to always save in, 30 years ago, 20 years ago, 15 years ago, defer those taxes, because we were taught at some point later in life we were going to pull out at a lower tax rate. Well, obviously, as we've seen, tax rates, and we believe tax rates are going to be higher in the future. So how do we get money out of those tax deferred accounts efficiently? That's the key word, efficiently. And then obviously my favorite type of account that I've talked about for years and years and years, those tax-free accounts or tax-favored accounts known as those Roth IRAs, or for some people that we've talked about with our Marty Ruby shows for years, the cash value within index universal life policies, the policies that are the investments that are tax-free for the rest of their lives.
Okay. And I know we're going to get into more, but the income valley itself, just why it exists, just wrap us up quickly on that.
So the idea with the income valley, and we're going to get into some numbers later on the show, is the thought process. In pre-retirement, let's just say you have a certain sum of income. In our example today, Carl and Sally might have $120,000 of W-2 income while they are working. Post-retirement, because they have tax diversification in their portfolio, they may be able to draw their taxable income down to 0 during that time frame before those required minimum distribution ages start creating that taxable income and creating that taxable situation to get higher and higher and higher. We're going to really talk about that 5 to 6 year period while their tax rates are potentially very low.
Okay, Rishi, we're off to a great start. Thank you so much. Important insights. Up next, we continue to discuss the income valley and show an example of why understanding this stage of your retirement is imperative when putting together a tax-efficient portfolio. Plus, later, Rishi explains qualified opportunity zone investing. That's coming up in today's Tip of the Week when the Wheelhouse Retirement Show continues. Stay tuned.
Retirement planning can be a daunting task. Investment planning, required minimum distributions, long-term care, and more. There's a lot to consider as you move from the working years into retirement. If you're interested in learning more about our processes and strategies discussed today, and you'd like to meet our team, join us for an upcoming educational event in your area. See our website or give us a call at 636-400-7889 for upcoming dates and times.
You've worked hard to build up your retirement savings, but do you know how much you're paying in fees in your investment accounts? Hidden fees can eat away at your hard-earned dollars, and most investors don't know what they're actually paying in fees. I'm Anthony Stryker, and our team at Wheelhouse Advisory Group can give you a fee analysis so you know exactly where your money is going. Call us to learn how to keep extra costs from eating away at your retirement. Get your complimentary fee analysis today.
Welcome back to the Wheelhouse Retirement Show. Here today with Rishi Ghosh, helping viewers understand an important stage of retirement known as the income valley. Rishi, I know that you love to use charts and graphs to really give our viewers a deeper insight of these topics that we're looking into. Today, it's the income valley. So take us through what this looks like.
So yes, I think, as opposed to always just talking verbally, right? Let's show some charts, let's show some numbers, and let's really talk about, as I described, the cash flow situation that so many people have an opportunity to take advantage of in their first few years of retirement. So I know I prefaced this in our first segment, but the income valley is really created between the pre-retirement phase of life and the first years of retirement leading to required minimum distributions. So as we can see from the chart, in the first few years leading up to retirement, with this family we have projected to retire at 66 years old, they have consistent income of their W-2 income, so about $120,000. Now, what happens in the income valley strategy is once they retire, Because this family has created tax diversification, they've saved money through all three different tax classifications of accounts: tax deferred, tax free, and taxable. The strategy is, for the first few years of retirement, we're going to actually drain the taxable accounts, the checking accounts, the CDs, the things that may not cause too much of a taxable situation. So as we can see on this chart, the income, all of a sudden, the gross income dips considerably to below $50,000. Now, eventually those accounts are going to run dry. So at 70 years old, 72 years old, the family now has to start tapping those 401ks, so we can see the gross income pops up. And then all of a sudden we get to those pesky RMDs. And as we know and we've talked about, the RMDs are not a request. They are a requirement by the government. Otherwise, they come with a hefty penalty if you do not pull those required minimum distributions. And for a lot of our clients, the income just goes higher and higher from that point forward. I mean, the amount they have to withdraw, even as they get older, even when they don't need the money, continues to grow and grow and grow. So how do we take advantage of this dip in retirement?
Now that we have identified their income, what do we need to do next to maximize their tax strategy?
So once we understand the cash flow, once we have the strategic income plan, we build that into a tax strategy. So when you have W-2 income, as we know, when we're getting paid from an employer, right, all of that money is earned income tax rates. Unless we're self-employed and have different ways to pay ourselves, most people just pay normal earned income rates. But the idea becomes the different classifications of tax accounts are taxed differently. So for example, if this family, as we said, between 67 and 72 years old, was strictly living off of checking accounts and maybe a little bit of pension and Social Security, by their earned income or taxable income being below $50,000, once we adjust for the standard deduction, once we account for a little bit higher because they're adjusted over age 65 years old, so they get a slightly higher standard deduction, this family actually had taxable income of zero for those first 5 years of retirement. Now, who doesn't want to not pay taxes in retirement? That's phenomenal, right? And people get all excited. And I've had people come to my office before where they say, oh, the first 3 years of retirement, I didn't even have to file a tax return because my income was so low. But if you believe that tax rates are going to be higher in the future, which 99% of our viewers and our clients do, we want to make sure that obviously we don't sit on zero income, but we also take advantage of starting to liquidate accounts, making tax-savvy withdrawals, Roth conversions, whatever it may mean for the family before we get to age 72, 73, 74, when we have to start taking some of these monies out of the accounts.
I know you're doing a great job always at Wheelhouse, helping your clients to identify their income valley. What are next steps for these families in terms of, moving forward?
So what we want to focus on with all of our families is, number one, the most important thing in all of retirement is income, right? Income's the outcome. If you can't pay your bills, your day-to-day bills, if you cannot live the retirement that you have dreamt of, your family's dreamt of, there's no point in retiring, in my opinion, because you're not living the goals that you've worked for 20, 30 years. But it's really creating a plan. And our retirement analyzer software that we've talked about for years and years on this show really helps show that income valley for our clients, right? It really shows what is the opportunity based on the cash flow, based on future taxation, based on their needed income, and create this visual representation for each individual family, customized towards them, so they can understand where is the opportunity there. In a lot of situations, if you defer capital gains, for example, in 2024, you can make up to $94,000 worth of capital gains and pay 0% tax on that money. I mean, that's an opportunity to potentially unravel some of those taxable accounts, trust accounts, those great brokerage accounts that so many of our clients come in with, right? Low cost basis, high appreciation of stocks, bonds, whatever it may mean. But how do I get that money out tax efficiently? It's a great opportunity.
Let's start with the first one. I know we're going to dive deeper here. Yeah. Tax-savvy withdrawals.
Yeah, tax-savvy withdrawals is very, very important, because what I have seen for years is people just take withdrawals for retirement kind of willy-nilly, as I describe it. They might say, what is my worst performing account, and just withdraw money out of there. Some people might say, what's my best performing account? I want to take gains off the top. And neither strategy is incorrect. But how does that affect the short-term situation, long-term situation? As I was mentioning a moment ago, so many people have these great brokerage and trust accounts, but they have no idea of how do I unravel it, because anytime they make a sell, they have to pay taxation on it. But is there an opportunity during this income valley to sell and maybe pay up to 0% income tax? There is a potential there if done properly, but most importantly, if planned for properly, because it doesn't happen because of just luck. It has to be planned for.
Okay, thank you so much, Rishi. Important insights and a lot of relevant information for you, our viewers today. And coming up after the break, Rishi will walk us through qualified opportunity zone investing. That's next in our planning tip of the week.
Have you thought about your plan for long-term care? Do you need a policy to pay for it, or can you self-insure? If you have questions about long-term care planning and all the options available to you, you're not alone. I'm Lauren Ferraro, and my team at Wheelhouse Advisory Group can help you create a plan to meet your personal needs and protect your hard-earned assets. If you are confused or concerned about planning for long-term care, call us today to learn how to steer your future in the right direction.
Retirement planning can be a daunting task. Investment planning, required minimum distributions, long-term care, and more. There's a lot to consider as you move from the working years into retirement. If you're interested in learning more about our processes and strategies discussed today, and you'd like to meet our team, join us for an upcoming educational event in your area. See our website or give us a call at 636-400-7889 for upcoming dates and times. Hi, I'm Rishi Ghosh with the planning tip of the week. On today's tip of the week, we are going to explore the realm of investing in a qualified opportunity zone, a tax strategy introduced by the Tax Cuts and Jobs Act of 2017 that could potentially help minimize taxation on your retirement portfolio. The inception of this program serves as a twofold purpose. It is intended to drive economic growth and revitalization in underserved communities while simultaneously offering a set of tax advantages to investors as an enticement to direct their investments into these areas. The program is distinctive because it presents one of the only opportunities for investors to defer capital gains taxes following a sale, provided that they reinvest those gains into a qualified opportunity fund within a specific time frame, which is currently set at 180 days post-sale. This investment strategy is unique that it allows for deferral of only the investment gains. Investors have the ability to retain their original cost basis while effectively deferring the taxes due on any gains from the sale until a later date. While most tax strategies require the full investment of the proceeds from a sale, this separation of the invested capital from the gains affords a level of flexibility that is uncommon in other investment scenarios. While these tax incentives are appealing, they should not overshadow the importance of the investment's fundamental performance. It's paramount that we not only seek tax efficiency, but also help ensure that our investments are fundamentally sound. This process is relatively straightforward. Capital gains are deferred when those gains are reinvested into a qualified opportunity zone fund within the 180-day time limit. It's important to highlight that this deferral isn't open-ended. The deferred taxes will be owed on the earlier of two dates, December 31st, 2025, when the Tax Cuts and Jobs Act is currently scheduled to sunset, or the date when the fund investment is divested and the money is sent back to the shareholders. Moving on to the benefits, we see that the structure of the Qualified Opportunity Zone Fund is such that they aim to deliver dividends, typically starting in year 3, but dependent on the individual fund. It is important to discuss who can leverage the tax benefits of Qualified Opportunity Zone investing and what makes an ideal candidate for this type of investment strategy. To be eligible, there are two main requirements for investors. First, the nature of the transaction. The gain should come from a sale or exchange with an unrelated party where unrelated is defined as less than 20% common ownership. This criteria ensures that the investment is truly geared towards fostering new growth rather than merely transferring assets within a related group. Second, the type of gain. It's essential that the gain is recognized as a capital gain for federal income tax purposes. This means that the profits from a wide variety of assets are eligible, whether they're highly appreciated securities like stocks and bonds, any form of real estate from primary residence to commercial buildings, or even other tangible assets like art collections or vehicles. Eligible participants extend from individual investors to larger entities, including C corporations and also pass-through entities like partnerships. In the case of partnerships, there's flexibility in whether the partnership itself defers the gain or passes it on to the partners to invest individually. Now, onto the ideal candidate for qualified opportunity zone investment. This strategy isn't for everyone. It's specifically advantageous for those who have financial stability to commit funds for up to a decade, who are comfortable with the nuances of real estate investments, and who meet the SEC's criteria for an accredited investor. While the tax benefits of a qualified opportunity zone fund are a compelling feature, it's important for investors to remember that these benefits should not be the sole consideration, and every investment carries inherent risks, and the allure of the tax incentives should not overshadow the need for diligent assessment of the investment's intrinsic value and potential for returns. Prospective investors should engage in a thorough due diligence and consider the totality of the investment's characteristics, including its risk and return profile, before proceeding in this type of investment. Qualified Opportunity Zone funds provide a very unique opportunity to preserve your family's overall net worth from taxes. As always, any decision like this requires a great deal more information and research and consideration. You should consult your attorney and tax professionals for advice and information concerning the situation. As our long-term viewers know, here at Wheelhouse, we don't believe in putting specific products or investments into a portfolio and hoping they work out, but rather first by starting and building the big picture, including the family's goals and resources and needs, then going piece by piece to determine the best products and strategies for their specific holistic retirement plan. While investments are very important in a retirement portfolio, learning strategies to preserve those great investments from taxation is equally important in a total retirement plan. That's the planning tip of the week. Stay tuned. The Wheelhouse Retirement Show continues next. Retirement planning can be a daunting task. Investment planning, required minimum distributions, long-term care, and more. There's a lot to consider as you move from the working years into retirement. If you're interested in learning more about our processes and strategies discussed today, and you'd like to meet our team, join us for an upcoming educational event in your area. See our website or give us a call at 636-400-7889 for upcoming dates and times. Did you know taxes could be your biggest expense in retirement? No one can avoid taxes completely, but with the right strategies in place, you could potentially reduce your tax bill in retirement. Having a plan to help protect your retirement savings from higher taxes could be more money in your pocket and less to the IRS. At Wheelhouse Advisor Group, helping people like you minimize your taxes in retirement is something we are truly passionate about. Call us today to learn about ways to possibly lower your taxes in the future.
Welcome back to the Wheelhouse Retirement Show. We're back with Rishi Ghosh and now joined by Lauren Ferraro. And in our last segment, we started touching on the 3 opportunities the Income Valley presents to retirees. We went over tax-savvy withdrawals. What's next, Lauren?
So the next opportunity is Roth conversions. That's one of our favorites here at Wheelhouse. So what that means is retirees prepay their taxes while they're in a lower tax bracket. So it involves taking money from an IRA, paying taxes while they're in that lower tax bracket, and then converting that into a Roth IRA, the benefit being that the Roth IRA grows tax-free, and distributions from the Roth IRA would also be tax-free, assuming the 5-year window has been met. Another big advantage of doing these Roth conversions is that you have less RMDs, required minimum distributions. So from a traditional IRA, at age 73, you have to begin taking those RMDs. And as we know, a lot of our clients don't need the RMDs for their day-to-day living expenses. So by converting more money to Roth IRAs where there are no RMDs required, you typically will have less RMDs in the future.
A lot of great important insights to consider. Let's move to the next one. I know charitable giving is part of this as well.
When somebody comes to Wheelhouse, Amy, one of the first questions we ask them, in addition to a plethora of other questions, we sometimes joke one of our first few meetings are like interrogations more than actually planning, because we're trying to understand each family's individual situation, what they are looking for out of Wheelhouse. But the one piece that we always ask them is Is philanthropy or is philanthropic giving or charitable giving, is that important to you? Whether it's built into tithing to your church or whether it's giving money to the St. Louis Zoo or your favorite 501(c) or favorite animal foundation, what exactly and how exactly do we build that into your portfolio? And oftentimes people don't have a strategy to do this, and there is opportunity there as well.
Yeah, so for those retirees that are 70 and a half and older, one of the opportunities is called qualified charitable distributions, or QCDs for short. So what that means is it's a direct transfer of funds from your IRA to that qualified charity of your choice. It's really important, though, that it's made directly. So we had a client in the past, before they came to us at Wheelhouse, they had money with a brokerage firm, and they thought every year they were making a QCD because the brokerage firm was cutting the check to the client and the client was bringing the check to their church. Well, you have to do it through a direct transfer of the IRA. So you can't just take a check to your church for it to be considered a QCD. So qualified charitable distributions, another benefit for those are, in particular, for those clients that are at RMD age. So for those clients that are 73 and older that don't need the RMDs for their day-to-day expenses, the money that they contribute to that QCD can go towards satisfying their RMD for that year. So it's particularly beneficial for those that are at RMD age that are charitably inclined.
Great insights, and I know a lot of our viewers are probably nodding right now. I had no idea about the direct transfer. Final thoughts on this topic? Anything else we need to take away from this?
So here at Wheelhouse, we don't just believe in one product or one tax strategy. We believe in creating a holistic, lifelong plan for our retirees. That's why that 5-year window leading up to retirement is extremely important. Oftentimes, viewers will reach out to us about 6 months before retirement, needing help with all of the pillars of retirement. Sometimes it's possible to do that in 6 months, while other times it may not be as possible. So having that time to plan ahead is very important. Also, what's important to think about, this is the time that retirees are changing their income plan from pre-retirement to retirement. That is a very large change for many of our clients. It's very important to take advantage of this income valley, and the key to taking advantage of the income valley is flexibility and having that time.
Yeah, I think Lauren hit the nail on the head right there. The fact is, every single year leading to retirement and into retirement is extremely crucial to not just have a successful short-term retirement, but a long-term retirement as well. And building that customized plan is so important.
Great insight, as always, from both of you. Thank you so much on a very important topic today. And if you need help identifying your income valley and taking advantage of some tax-efficient strategies for your family, don't delay. Reach out by phone or on the web to get started planning for your ideal retirement future. For Rishi Ghosh, Lauren Ferraro, and the team at Wheelhouse Advisory Group, I'm Amy Sharp. Have a great week. We'll see you next time.